Hi there, it's Bill with Smart Trades, July 30th. Let's see, it's about 10:45 Pacific time. And taking a quick look here at the S&P and the Dow, I wanted to look at the longer term charts and also talk about some things from Prechter's great book, The Elliott Wave Principle. One of the things that he talks about, basically the broad concept, Elliott Wave 101, is the definition of various types of corrections, and in particular, flat corrections. And um, in that description, he talks about, what we would call, or what he calls, a regular flat. A regular flat terminates about at the level of the beginning of wave A. That is, B terminates about at the level of the beginning of wave A. Well, let's look at the S&P monthly, going back to before the year 2000, and that top was right around 1552 at the beginning of wave A. B tops around 1576, I believe. So that, in other words, it's 1.5% above the top of wave A. So that's pretty close. That would be, in my way of thinking, uh, about at the level of the beginning of wave A, particularly when you consider there's 8 years between these two peaks, or almost 8 years. And over that time, we've had inflation, deflation, the S&P itself has changed, and so a 1.5% margin of error, even less on a closing basis, is quote-unquote about at the level of the previous wave A. So most everybody agrees that this is an A down, a B back up. The only question is this an irregular B? And to my way of thinking, the simplest and most obvious answer to that is no, it's a regular B. It tops about at the top of wave A. And from there we have C down, which goes slightly below the bottom of wave A. And, quote, wave C terminates a slight bit past the end of wave A, according to Prechter's Elliott Wave Principle. Okay, so now let's take a look at the Dow. And okay, here's the monthly Dow. Now, the Dow, on the other hand, it did go substantially above the top of wave A. That is, B did. And let's see. In this case, wave B of the 335 pattern terminates more substantially beyond the starting of level of A, and C more substantially beyond the level of the ending of wave A. And indeed, B terminates more substantially above the top of A. There's the top of A, and here's the top of B, and we're more substantially below. Moreover, later he talks in ratio analysis that the most likely relationship between A and C is 1.618. Well, the decline of C is, at the level around, let's see, 6,900 or so, is 1.618 times A. So you have A down, irregular or expanded B up, and C more substantially lower than the flat correction of the S&P, and just beyond the 1.618 ratio of A. Again, this is textbook, literally textbook Elliott Wave as published by Prechter back in 1978. It's interesting, though, that neither Prechter nor virtually any other Elliott Wave student that I'm aware of is actually looking at this as a possibly completed correction. Now, what this rally is after that remains to be seen. Is it an impulse up? Is it a zigzag, which could be part of a larger corrective rally? It's hard to say, but the bottom line is, again, both on the S&P and on the Dow, these are absolute textbook relationships of the ABC pattern. And here's something very interesting. This is in Associated Rules and Guidelines. Prechter quotes Bolton. He says, Bolton used to say that one of the hardest things he had to learn was to believe what he saw. Okay, well, what are we seeing here? We're seeing textbook Elliott Wave relationships, and the market bottoming right at textbook Elliott Wave targets, yet The vast majority of Elliott wave analysts are saying, nope, that's not what it is. It's not an ABC, it's just one of C. And then it's got to go a lot further down or whatever. And one other thing, again, this is in that same section, applying the basics. One thing that must be understood is that competent analysts applying the rules and guidelines objectively should usually agree on the order of probabilities for various possible outcomes at any particular time. That order can usually be stated with certainty. Let no one assume, however, that certainty about the order of probabilities is the same as certainty about one specific outcome. Well, anyway, again, what is the most probable scenario here? That, again, I'm quoting Prechter, 1.618 times A is the most probable relationship of C to A. In a flat correction, they're going to tend towards equality, as is the case in the S&P. So anyway, I'll let you decide, but it is interesting. The most popular analysts out there, A, have been wrong, and B, are still buying this idea that this is just one of C. Now, I'll be the first to admit, yes, it's possible. It's possible that this is just one of C down. But again, textbook Elliott wave, right out of literally Prechter's Elliott wave principle, targets very near the level that we've already achieved. Anyway, I'll have a short-term report coming up shortly, but hopefully you enjoyed this and have a great weekend. Bye-bye.